Interest rates are really like the price of money. It's the rate of interest you have to pay to borrow money from the bank. If you hold a mortgage, that's the price of the mortgage. A big part of the Great Recession was the collapse in house prices around the world, and so interest rates have been kept very flat and very low. And part of the reason is that if you were to start raising interest rates, then it's going to have an impact on the price of borrowing, and it's going to lower house prices. A rate of interest is also the return savers get from investing in a bank or in a particular share. But it really matters because interest rates essentially are the tool that's used to stabilize the economy. The responsibility for economic policy and stabilization, trying to keep things on an even keel, has been given to central banks. And I was one of the guys who used to set interest rates.
Bank of England now has a difficult decision to make tomorrow on whether to cut interest rates.
So we went into a period in September 2008 where we started to cut interest rates from around 5% to 0.5%. And I was flying across from the US to the UK, and I looked up and there's a captain of the aeroplane standing in front of me with one of these in his hand, very large bottle of champagne. And I said, aren't you supposed to be flying the plane? And he said, they've sent me back with this to thank you because what's happened is the mortgage rates on our loans have gone from 7% or so to 2% or so, and we know that you were the guy who was trying to cut rates. So not often the captain comes to your seat and hands you a bottle of champagne.